I'll wait. As soon as we have 20 people online, I'll start. All right, we now have 20 people online, so I'm going to start. Good afternoon, everyone. Trust you're doing well and staying safe. We will continue with lectures. So far, up till now, we have assumed that as a project manager, you're working for a company, you're working for an organization. So your job is to create a project within an approved budget, within an approved timeline. You have a group of stakeholders, you have the sponsor, and people who are looking over what you're doing. But the money is not coming out of your pocket, although you need to steward it and ensure that you're getting good earned value and all that. Now we're going to switch gears a little bit and assume that you are the proprietor of that company. You're the owner of the company and you want to engage in a software project. Naturally, that's also a business for you. You want to do a business that is profitable. So we're going to talk about pricing your software. In an organization where you're just an employee, no matter how senior you are, how much they sell. In fact, they're not likely to sell the product. They're probably just going to use it internally. You develop a payroll system for an organization, they're going to use it internally. But now we're going to consider the situation where you're developing software for commercial purposes. So the first thing we'll talk about today is how to price your software. Remember earlier on when we were talking about budgeting, we said you make a budget to put in some contingency. The contingency is supposed to take care of uncertainties. There's some things, especially in the early stages of the project, where you're still defining your requirements, you haven't quite nailed them down. You put in a fairly large percentage of contingency just to take care of the uncertainties. So in order to estimate your price, you go through all the processes we talked about earlier. You must have a scope for this software that you want to market, you want to sell to the whole world. You must have a scope for it. You have an overall budget for it. How much is it going to cost you to develop that software? So what is it going to cost you to get your hardware? Your hardware may be as simple as a laptop. What is it going to cost you to get software? Is all the software you're going to be using, is it all free or you have to pay for something? Travel. You maybe go to a client site or go to some places because of that project, because of the software you're trying to develop. Cost of training yourself and maybe other members of your team. Maybe you've gotten together with some of your friends and decided to learn certain tools, certain programs in order to be familiar and in order to gain the competence to develop that software. You're going to take into account the cost of testing. Remember, we just talked about testing. Testing takes time to develop your test scenarios, the various levels of testing, units, integration, user acceptance, operations acceptance. So you need to build that in. When we talked about quality, we talked about the cost of conformance. So part of what you're going to, part of the cost of your software will include the cost of quality that you have built in. The cost of mobilizing staff, maybe a few of you, maybe 2 or 3 friends got together, but you need a few other skills, even if it's just the secretary and admin, the cost of getting that person and any other effort that goes into creating that software. Now, of course, logically, when you want to sell a product, you want to be sure that the selling price is higher than the cost price. In other words, what it costs you to develop the software is not the exact amount you're going to demand when selling it. So if it costs you, say, 100,000 naira to develop the software, at the very worst, very least, you need to realize you need to recover 100,000 naira from customers who will buy your software. Sometimes that cost is not realized once at one time. It takes a long time, especially for software where people subscribe and pay maybe a monthly fee or an annual fee. So the original cost, the 100,000 naira, may not come in from year one. It may take several years to realize that cost. There are ways, there are techniques for calculating the cost and ensuring that you factored in inflation and all that. It's called net present value, but that's out of scope of this class. So your selling price should ordinarily be higher than your cost price. Now, there's no simple relationship between your development cost and the price you're going to charge customer. There are other factors that will determine at what level you're going to sell at what level you're going to set your selling price. There are several factors affecting software pricing. Number one factor is contractual terms. If you have a certain client in mind, does that client want to collect the source code from you, or the client will allow you to retain ownership of the source code? Now, there's a big difference there. If you're going to hand over the source code, that's the end. Whatever revenue that client pays you, that's the end, because you no longer own that source code. You no longer have intellectual property on that source code. But if you own the source code, you've given the clients the executable and what they need, then in future, you can modify that source code for another client, or you can upgrade it and do other things. So the ownership will affect your contractual pricing. So in the first scenario where you're going to hand over the source code, you're likely to charge higher. Why? Because your revenue stream has dried up. You've sold it and that's the end of it. You cannot make use of that code again. But if the code remains with you, then you might charge less because you can do other things. You can still realize more money from the code that you're holding. Another factor that would affect how you price your software is the uncertainty of the cost. Is the uncertainty of your cost estimate. I said earlier that at the very early stages where there's so many things that are uncertain, you put in a large contingency. In the organization where I used to work, we had different stages. The early stages, you can put in up to 50% contingency. So if you estimate that the software is going to cost you 100,000 naira to develop, you put in a 50% contingency and say, okay, this is the target price, 150,000 naira. Okay, but as you get closer, you've gone through the various stages, you've refined your estimates, there's less uncertainty, then you narrow down the contingency. And by the time you're ready to go live, your contingency is probably like 5% or 10%. So if your estimate is still uncertain, then it's better for you to increase the selling price because other things might come in. And the way to do that is to build in a contingency over and above normal profit. Now, some organizations have profit targets. They say, like, whatever product we're going to sell, we must make at least 10% profit. So that 10% is your profit target. Now, this extra we're talking about is over and above the profit target. So if, back to my example of 100,000 naira development cost, your profit target is, say, 10%. So the minimum is 110% because 110,000 naira, because you want to make a 10% profit. So you now go over and above the 110 and put in a contingency. If it's a 50% contingency, then you add 55,000 naira on top of the 110. So you have 165,000 naira. That takes care of the estimate uncertainty. Another factor that could affect how you price your software is your own financial health. It might just be a 1 or 2 man company. If you have financial difficulties, you may want to lower your price so that you can, have people take off that product from you. So back to my example of 100,000 development cost plus 10% profit. Instead of putting a contingency of 50%, you might go as low as 5% contingency. So you can tell, oh, you can buy it for 120,000 naira because you want to gain that contract. And you need money desperately. You need money to flow in. If money is not coming into your company, you might not be able to afford updates or fixes to the software. So developers who are just starting out or who have financial difficulty tend to charge lower price. So it's better to have a smaller profit or maybe just even break even rather than going out of business. Because if money is not coming in, you're going to go out of business. You'll be sitting on a product that nobody can afford. Okay. So your cash flow, the fact that money is coming in is much more important than having profit, especially during economic difficulty times. So those are three factors we talked about. Contractual terms. Is the client going to collect the source code? If they are, then you charge higher. If they're not, so that you can reuse your source code, you charge lower. If you're not too certain about the cost estimate or some of the requirements, then you have a larger contingency. And then if you are in financial difficulty, you don't have too much cash to play around with, you might want to reduce your profit margin so that you can sell the product. The other factors, another one is market opportunity. If you're bringing a product that is going into a saturated market, so if your software already has competitors in the market and you want to break in, most of the time, the only way to break in is by lowering your price so that people have a lower cost. I'm going to use an example, peak milk and 3 crowns. By the time 3 crowns came on the scene, I'm not even sure they're not one and the same company now. 3 crowns had to come in at a lower cost just so as to break into that market. So they were competing on cost. They may not have been making a lot of profit. In fact, their profit might have been so slim, but they needed to break into the market. So the same thing for the software market. Unless you're doing something so new, so niche that you're the only one doing it, you might want to look at what similar products are doing and how they are priced, and then price yours just slightly below them so that you can get a foothold in the market. Okay, and once you are able to at least have a few people paying you for that product, you can then build that into recovering your money much later. Another factor that could affect your pricing is the volatility of requirements. Today, the client tells you, I want you to do A, B, C. 2 months down the line, say, oh, no, I want it B, C, E. If requirements keep changing, you may have to lower your price just to get a foothold. And then each time they come back for a change, you charge them higher prices for those changes. So if requirements are volatile, you might want to start low and then go high. Each time they come for a variation and say, oh, we don't want it this way again, we want it that way. Then each time they come back to you, you charge a premium for that change. So those are some of the factors that affect how software is priced. There are two main strategies, and that's just going to summarize what we've talked about a few minutes ago. You can underprice. There are two main pricing strategies. You can underprice, that is, price lower than what the normal market would have expected. The reason you might be doing that is because there's a market opportunity. You want to break into the market. You want to compete on price. It might also be that you have some financial difficulties and you want to be able to retain your staff, pay salaries, pay rent, and all that. So you might go lower just so that you can get some revenue coming in. So those are the underpricing strategies. Now, there are also some higher pricing strategies. Sometimes a client might say, look, I want to use this software for 3 years, but I want the same pricing all 3 years. For those of you who have subscribed to software, either through your phone or something, you notice that the price changes. If you subscribe to Netflix maybe 2-3 years ago, you're probably paying something like maybe $10 or $11. And gradually they keep changing. $12, $13. That's the way the game is played. But a client might say, look, I want the same price. I'm going to be with you. I'm going to use your software for 3 years. But I want to pay exactly the same price every single year. The way to make up for that is to charge a higher initial price. So if normally you would have priced your software for 10,000, and then because you want to take care of inflation, the following year you might increase it to 11 or 12,000. 3 years later, you might increase it to 15,000. And this client is saying, I want the same price for 3 years. So what you do is say, okay, my software costs 14,000 naira. So you get 14,000 every year for 3 years. And by the time you do the math, it comes to the same thing. It might even be slightly better off. So those are the two main pricing strategies: underpricing or overpricing, or increasing your pricing so that you can make up for losses. Okay. The important thing is that you want to price your software in a way that will help you win, in a way that will help you stay in the market. What most of the time you're pricing it based on what you think the buyer is willing to pay. Of course, the knowledge of what other competitors are charging is also important. Okay. So if what the buyer is willing to pay is less than your development cost, then you either drop the project or reduce some of the functionality. Again, if you look on any of the app stores, you'll see some software, they have different versions. There's a light version that costs maybe $4. Okay. But the $4 version has very little bells and whistles. And then if you want a pro version, they'll say, okay, that's going to cost you $10. So if the client or if the buyer is not willing to pay a price that covers your development cost, then you reduce some of the functionality just so that you can remain in business. And next time the buyer comes around and says, oh, I want this functionality, that functionality, then you charge them an extra cost for that. And you build in a few extra specifications. Okay. Again, if requirements change, each time you need to go back and modify your program because the client has come back with new requirements, you charge them higher so that you can make up for the initial shortfall. So overall, when pricing your software, you need to take the following into consideration. The price you charge is not just dependent on your estimated development cost and profit. You need to look at other things, other factors, the size of the market, where you are in the market. Is there an opportunity for you to break into the market? What is your financial health? Do you need to ensure that revenue keeps coming in even if you're not making a profit? The client, how volatile are their requirements? You also need to take that into consideration so that you can compensate for some of the risks that happen when you price your software either too low or too high. Okay. Any questions? I'm just looking at the chat. Any questions on software pricing? We have questions on software pricing. Like I said, we're taking a different view now. We're not assuming that you are within an organization and everything has been paid for, and it's not your business how they find the money. Okay, Prince, I think I sent out the PDF of the notes. So I already sent out these lecture notes. If you can take a look at that, you will see the factors that I talked about. Basically, just to go back, I talked about contractual terms, that is whether you give up the source code or not, cost estimate uncertainty. I talked about financial health, that is your financial health as the business owner, as the founder. We also talked about market opportunity, that is trying to get a foothold in the market. We also talked about requirements, volatility. And each of those will require either an underpricing strategy or an increased pricing strategy. But the important thing is for you to win the customers, win market share, and of course, recover your costs. Okay. Any other questions? Okay, let me go to the second part. This time, this is not strictly speaking project management. It's about how to fund your software project. I imagine that some of you have some ideas You want to create some super software that's going to, append Microsoft and Amazon, whatever. Okay. How do you fund it? How do you go from just having an idea to having a viable product that people want to pay for? Because it's important that whatever you develop, whatever software you're coming up with, you must find people who would be willing to pay for it. So how do you fund your project? There's a chart that I put in the PDF, and it talks about the startup, because when you're just starting your business, it's a startup. It talks about the startup life cycle. And as the life cycle progresses, as you add value to your software, the valuation of your product increases. Initially, when you're just putting it together, you have an idea, you and two or three other friends are thinking about what to do. This problem exists in the market, you can address it doing this and that. That's the ideation stage. And at that time, your valuation is close to zero, because you have not even put the idea into practice. You have not even done anything that people can look at and decide that they want to pay for it. So you can imagine that for the founders of Paystack, this was probably back in their university days at, was it Bapper University that they both went? When they were still comparing notes, that's the ideation stage. And they say, okay, maybe when we graduate and we have more time, we'll write a few codes and test. Okay, so at the ideation stage, sometimes you have several ideas, and you're just trying to crystallize them, define those ideas, put them down on paper. Then as the ideas begin to make sense, and let me say something about this ideation stage, make sure that your idea is solving a real problem. Okay, because if it's not solving a problem, then there will be no buyers, there will be no customers. What is the gap that you have noticed, either by your personal experience or you read about? What is the gap? What is the need that you have noticed that you want your software, your project to address? Then you can take the ideation stage a little bit further by, maybe if it's a software project, to put some codes together, you test some of the assumptions you have made, either about the project functionality or about your customers, about what they really need. At this stage, and I'm going to talk about where funding comes from later. At this stage, you're trying to put together what they call an MVP, minimal viable product that might make it. The fact that you have an MVP doesn't mean it's going to be a financial success, but at least something that people might be willing to look at. Okay. Now, between the ideation stage and the discovery stage, which is the testing your assumptions and doing some coding, testing your assumptions about what customers want, you need some money. At the minimum, you need to be able to afford your own laptop. You need to be able to have internet access or buy data to your phone. That money could come from you and your co-founders. Hopefully, you had some savings, or you might be able to get some fund from family, friends. You might be able to get some grants. There are a few institutions providing funding and grants to such startups. So once you have what is called an MVP, a minimum viable product, you can then begin to validate those assumptions. Validate, it's almost like getting into a beta test. Remember when we talked about beta testing? Get a few people to just run with your product and see, let them give it a test drive. See if they are interested. Some friends, some people might be able to give you good feedback that you get back into that, you put back, you incorporate into your product. After that, you go into the customer creation phase, and then you begin to, build demand in people. You begin to sensitize people to the need for this and begin to acquire customers. And there are various ways in which you acquire them. There are different funding requirements for each of those stages. I'll talk about that in subsequent slides. Now, as your business, as your product grows, you'll need even bigger fund. Okay, so you build a viable company, you get venture capitalists to come with their funds. So this, the next slide, I don't know if you're looking at your PDF. At the initial stage, you have next to nothing. Okay, other than your personal savings to do something. If you're fortunate enough, you're living in your parents' home, you can use the garage or use your bedroom or something. Some other people don't even have that luxury. You might need to go to a co-creation space like CC Hub, where for minimal amount, you can take your laptop, you have a desk to use for a day, but money is tight. Nobody is going to fund a project that is still in ideation stage, except for family members. Okay? So initially, count on having personal savings. You are in your fourth year now, you have one more year to go. If this is the time to start building a little bit of egg nest, try and raise some money on your own that you keep, especially if you're interested in getting into the tech space in Nigeria. You need some personal savings. Then once you get more comfortable with your ideas, you approach your family and friends. In most literature, you'll see this either written as two Fs or three Fs. Two Fs mean family and friends. Three Fs mean family, friends, and fools. Because it's only a fool, someone who is not related to you, who is not your friend, who will give you money at that stage. So if I have a few close people who will throw money into your project. By that time, the valuation is getting to like $20,000, probably about 10 million naira, thereabout. Your MVP is beginning to have some value. Okay. Then you begin to source for fund. There's crowdfunding. It doesn't work too well in Nigeria. Most of the time, when people do crowdfunding in Nigeria, they do it towards specific physical goals. So you'll find the agri-tech companies, the Crowdivest, the Thrive Agric, and a few others. They are able to do crowdfunding because people can see the product. I don't know how successful crowdfunding has been for software. Remember when we first started this project, this course, software projects, you really can't see them, they're invisible. So crowdfunding can be a little bit tricky for software projects. And there's another group of people called angel investors. They also come in at that early stage. Angel investors, they're not angels, they're human beings. They would put money in your business for certain considerations. They will put money in the business to help you scale, to help you move that minimum viable product to something that can have customers and generate revenues. Most of the angel investors that I know would actually not come in until you have at least one revenue earning, one paying customer. So they call it post revenue. Your product must be good enough for at least one person to agree to pay for it. Now, that one person could be a member of your friend, a member of your family, but someone, they need to see that you've started earning money from this project. You may not be making a profit. Revenue is not the same thing as profit. Okay, someone is paying. Anything they pay for that product is revenue. Angel investors provide both money and mentorship, and that's why they're really, really so important. But it's a small group of people. They don't have millions and millions of dollars to throw into your project, but they can help you scale to that level where you are on your own. Now, beyond the angel investors, once you're finding your feet, you can then approach people that call venture capitalists. And they have a series of financing based on the size, depending on the size of money you're looking for. Series A, Series B, all the way to Series E. They will put that in your project. Well, of course, that's a much more formal relationship than the one you had with your friends and family. You probably didn't sign any contract with your friends and family. By the time you get to angel investors, they want some form of formal assurance that the relationship is a formal one because they're putting money into your business. Okay. Now, as your business begins to grow, your valuation is now maybe $10 million or more. You can do one of two things. You can go for an IPO. IPO means initial public offer. In other words, you're going public. You're going to be listed on the stock exchange. And everybody from all and sundry can subscribe. They can buy shares in your company. Or your company can be acquired. And that's what happened to Paystack. Paystack was acquired by Stripes for, I think, about $200 million. That's a very, very good price for a project that was started by a group of students. Okay. Now remember that once you have an IPO, it's no longer a private company. It's a public company. You might still be able to retain your position as CEO and founder, but you now have a board, you now have other stakeholders who are responsible to your shareholders. As soon as you have an IPO, you have shareholders and they have a say in what goes on in your company. Okay. I have another slide there that just shows you the various levels of investment threshold. Your initial money comes from you and your founders, then angels will come in, then the seed funding, and then the venture capitalists. Now, when you are raising money, what kind of money should you raise? Should you take a loan or should you sell shares? And that's actually, we're talking about debt or equity. How do you raise money? If you take a loan, loans are less forgiving than equity. Because when you obtain a loan, you are under obligation to pay it back. And the time period is usually short, maybe 2 to 3 years, especially in our country. You need to pay back, usually at a fairly high interest rate within that short period. And you must pay at the agreed interest rate. Now, for a startup, that can be tough, especially if you're struggling. If all you have is money from you and your partners and maybe a few friends and uncles, then going to take a loan could be suicidal. Because whether your product becomes viable or not, whether your product sells or not, you have to repay that loan. The alternative for a startup is to sell shares, sell a portion of your equity to those who will fund it. So, for instance, by the time an angel investor, a VC, venture capital is coming, they will put in money all the time, all the same. It's not a loan, but they are going to do that in exchange for a percentage of your company, in exchange for equity. For a startup, the good thing is that equity money is almost sunk. If you make money, they make money. If you lose money, they lose money. You don't have to pay an interest on it. However, equity also has its downsides because you now have, maybe you started with 2 partners. So you had roughly 30% shares each. If you bring in equity partners, if you bring in angel investors and venture capitalists, and they're buying a portion of your company, your own shares will go down. They might give you enough money to, develop the product and sell it and make a lot of money, but your own stake in the company is much reduced because there's just a finite way in which you can slice the pie. Okay. Now, if care is not taken, your equity partners can get so powerful that they can oust you, they can remove you as CEO. I don't know if you've been following the news about Health Plus, the retail pharmacy chain. That's exactly what happened to that lady. She brought in equity partners, they pumped money into her business, and then a few months ago, they took over the business. But I think she's in court and she's trying to fight that. So there are pros and cons for doing debt or equity, that is borrowing or issuing shares, giving people shares in your company. Some angel investors or even some venture capitalists or early funding people do what's called a hybrid. It's called a contract note. A contract note, or you can call it a contract note. It's like debt, or the convertible note is the convertible note. It's like debt initially. You need to agree on the terms. And I say you pay 10%, it's repayable in 4 years or 2 years. However, at the time the repayment is due, you have the option to convert it to equity. So they give you that money initially as a loan. And depending on how your business performs, they convert it to equity. In other words, you don't have to pay it back. Now, In order for a convertible note to work, you all need to have done your homework. They will look into your finances, they will look into your projections and see whether that works or not. And it's like a middle ground. It protects you and it also protects the angel investors or venture capitalists. Okay, so those are things to consider when raising money, because after a while, you're going to run out of savings. Your uncle is going to get tired of giving you money every other month. You need to find money. Let me pause for questions, if any. Okay, amazing. Okay, you're talking about uncertainty of cost estimate affecting pricing. Remember when we talked about when we talk about project scope, build your WBS and all that, especially for a commercial product, you're assuming certain requirements, okay, based on your own experience or limited knowledge. In reality, those requirements might be different. So you now need to go back and tweak the product you've already developed. Okay, so you have not you have a workable or viable product, but it may not be the final. Okay, so you were uncertain because you didn't know. That's where the uncertainty comes in. You didn't know about the scope, even your cost estimates. Probably you had a lot of contingency built in. That's the way to protect yourself. Okay, so uncertainty in some way is taken into account in costing, but when it comes to pricing, you also need to know that what the product you're offering to them may not be the final product that you actually deliver when they sign you up, because you didn't have all the data you need, you didn't have all the information you need when you were building the project. Okay, does that help? Amazing. Now, Emmanuel, you talked about pricing lower to break into a market. What is the yes, it happens. You talked about price war, so to speak. The last thing you want to do is get into a price war with a big someone that has deep pockets like Amazon. So you pick your battle. Sometimes you might want to look for a different segment of the market, a segment where no one wants to go. I'll give you an example in the fintech space. The banks they have all the advantage and all that, but there are a lot of people who don't have bank accounts and they want to carry out financial transactions. That's where the likes of Paga and Kuda Bank and all that, they targeted a different segment of the market because they can't really compete with the banks. Okay. Now, the telcos are actually going into that same market with their USSD star 173 or whatever, because you don't need a smartphone to use that. So, to your question, lowering your price to enter into a market, make sure that it's a market where you have the muscle to compete in. Don't try to take on an Apple or an Amazon. You're going to lose because they have the money. They don't mind, throwing out money just to get rid of you. Okay. Does that help, Emmanuel? Okay. So let me just finish off on this. Now, initially, I said earlier that revenue is different from profit. Revenue is what customers pay you for your product. Okay. Now, at the initial stage, you are not making money. As a matter of fact, you're losing money. Someone did a study I read a paper or a short article a few months ago and wondered why many startups in Nigeria die. They just fade away after 2 years. And the not so surprising answer was that 2 years is the time that their rent expires. You go and rent a space, you pay the 2 years upfront, and then by the end of the 2 years, you don't even have enough money. No revenue is coming in, so you can't afford to renew your rent. So it's important when you're starting up a business to remember that your cash flow is going to be negative for at least 2 or 3 years. I've seen a lot of financials for startups. If you're really, really genuine, if you're being truthful, you're going to be cash flow negative for 2-3 years before you break even and start making money. So you need to be prepared for that. in getting your seed funding. You need to be prepared to have enough from your savings, from your friends and family, even from angels. Some angels will invest in you even before you start making profits. All they want to know is that you have revenue. In other words, you have at least one fee-paying customer. That gives them comfort that that product is at least viable. So I thought I should point that out. Many people in the industry, they'll say a lot of startups, first of all, go through a valley of death, a valley where you're just burning money. You have a burn rate. You're just burning money. And then gradually, as you increase your uptake, people are signing up and paying. You gradually break even. Break even means your development costs and your selling, your revenues are at par. So if it costs you 110,000 to develop, you're making revenues of at least 110,000. So you're breaking even. You're not making a profit, but you're no longer in the valley of death. And then over time, as you acquire more customers, as you tweak your functionalities, you make profit. And you make so much profit that you begin to attract at later stages a lot more people. Venture capitalists want to invest in you. Your seed A, Series A, Series B, Series D. People want to come in, invest in your company to help you grow. Of course, as they're helping you grow, they're also making money because remember, they are equity partners. The more you make, the more they make too. And then when you get big enough, you can decide to go public through an IPO or through mergers or acquisitions. Okay, so I guess your question should be, if you're thinking about this, where are you going to get help? Where are you going to get support as a startup? There are different types of organizations that would support you. There are incubators. There's one very close to Unilag, the CC Hub. They're not very, you need to apply and all that, but it's not a particularly competitive space. Okay, you can be there. It's a place for you to go without having to spend all that money on rent and all that. Go with your laptop, chat with people, because there'll be other people around you. You can learn some skills. You can compare notes. You go in there while you are developing your product. You do that early in your development. And a lot of the successful companies we have, a lot of the successful startups that we have now in Nigeria, at least in Lagos, a lot of them pass through that CC hub or other hubs. Okay. They might, from time to time, give you some seminars. They might provide legal advice. They might provide mentorship, but the benefit here is really about networking with other fellow developers. You are sharing your experiences with certain tools. You take your laptop there, but you have free Wi-Fi, free electricity. You don't have to go buy a generator and put fuel in it because they took light in your house. So that's the benefit of incubators. And there are many of them in Lagos, in most cities and around the world. Now, another group of people that can provide support are angel investors. Yes, they provide money and they expect their money back, especially if they signed off a convertible note. They expect their money back, or if your product is doing well enough, they'll convert that loan to equity. That's why it's called a convertible loan. It's an ongoing thing. There are many angel investor groups in Nigeria. There's Lagos Angel Network. There's Rising Tide Africa. There are quite a number. Okay. They're coming in as investors, but they're also coming in as mentors. They come in early, they advise you. There are some groups that I've been involved with. We didn't invest, but we offered them mentorship. Okay, so that's a very valuable support. Excuse me. That support is usually offsite. They won't come to your company. You need to go to them. Then you have accelerators. Okay. Accelerators, in some literature, you'll find them called combinators. And the most, the most popular one is the Y Combinator that's in Silicon Valley. This is like a cohort. They take in people in batches, and it can take up to 6 months. It can be a source of investment, but it's also like a badge of honor. If you can show that your company, your product has gone through an accelerator program, investors are likely to be interested in you. Venture capitalists go there to recruit. It's like footballers, football players. Some scouts go to Olympics or World Cup to recruit. So some investors go to these accelerators, especially Y Combinator, to recruit, to look for deals, look for good companies that they can invest in. You are mentored by people around you. You attend several seminars, and it's an on-site program. You need to be serious. The worst thing you can do for yourself is to get kicked out of a Y Combinator or an accelerator. And then there are other organizations that provide a hybrid, part incubator, part accelerator, angel investor. It's a much longer product. It's a much longer program, but at least it gets you the support you need. I know that the Nigerian government has a few uh, initiatives. I don't know the exact details, but I know that some time ago, the vice president had it like a board or a committee of people to help. Okay, so what's the difference between accelerators and incubators? Incubators are like the beginning. All you're there, all they provide is an environment where you can do your development, where you can build your product, where you can network with fellow developers and exchange ideas. In an accelerator, you've scaled certain things, you have a product. Okay, the pace at the accelerator is more intense because you're going there to not just you're going there to fine tune your product, but you're also, in a sense, actually marketing yourself and marketing that product. So you see, there are some of these big names that we hear about, Stripes. Some of them went through that Y Combinator. I think one of our Voyages companies too went through that. I don't know if it's Andela that went through or Flutterwave. So again, it's like a badge of honor. Once they hear that you've been through that accelerator program, people are likely to listen to you. Okay, yes, amazing. Yes, Tolu Elumelu also has funds that they can invest in that. Can you get investors before launching ideas? Not likely. Like I said, it's only your friends and family who would be willing to give you money at that early stage, because you have not really, it's still in your head. That's why it's called an ideation stage. You have not demonstrated that you can have a product out of that ideation stage. Okay. Any other questions? How does one gain financial knowledge in raising and gaining money as a startup in order not to make a mistake? That's a very good question. A lot of organizations actually run what they call master classes or webinars for investors. So you can be on the lookout. You can be on the lookout for that. And if I find something that's already done that you can listen to or read through, I'll send it to you. But follow some of these groups online, and then you'll know when they are offering an investor masterclass. Lagos Angel Network is a very good one. I know that. I'm also familiar with Rising Tide. Olufeko Samuel, yes, I do invest. Thank you. Any other question? Okay, just to make life a little easier, this second part of the lecture is really more for your information. It's not part of the curriculum. I decided to add that. I haven't, prior classes, I didn't include that. It's really for your own consumption. So I'm not going to be testing you on how to get funds for your project, for instance. Okay? Any other questions? What is the best percentage one can get right now that is better than banks? I don't know what you mean by that. Percentage as an investor? ECHO, yes. Funding your software project, yes. That's the part that I will not be examining. So you don't expect any questions on that funding your project software. So Prince, what percentage are you talking about? Percentage in payback and interest. Um, there are quite a few. I alluded to something called net present value earlier. It's outside the scope of this course. But for now, I'm sure you're aware that rates are very, very low with banks. They're probably paying you like 1% or 1.5% on your savings. Treasury bills are like 2% thereabout. So a note, a convertible note that's at even 7% is a lot better than bank. Yes, the period, the time frame may be 2 years or 3 years. Usually you don't have a convertible note that's longer than 2, 3 years, but that is a guaranteed return. So there are a few other investments that have higher returns than banks. In fact, right now, there's a disincentive for people to put money in banks because the rates are so low. However, with banks, even if the 1% is guaranteed, with an investment, it's not unless it's a debt. Remember when I talked about the difference between debt and equity? If with equity, if they make it big, you too make it big. If they lose, you lose. Your money is gone. Okay. So as an investor, especially in a startup, you're taking a gamble. You're taking a risk. All of your money, you could lose all of the money if the project fails. And I gave the example of people who didn't even have enough money to pay rent. That was the end of the project. They never launched the software. And so anyone who may have invested in them, it has lost all their money. That's why at that early stage, it's only your friends and family that would give money to invest at that stage. Any other question? Let me just say this. Don't invest money you can't afford to lose. Okay, I'm going to put it down so you don't forget it. However, when you win really, really big. You can imagine those who invested in Paystack, either as angel investors or venture capitalists. You can imagine how they feel now. If someone invested $10,000 with them 3, 4, 5 years ago, they are all smiling to the bank right now. But that's maybe 1 in 10. Some will say that when you win big, it makes up for all the other 9 losses, but that's yet to be tested. You take risks, but you take reasonable risks. In other words, if one advice I got when I retired from ExxonMobil was not to invest all my gratuity in startups because everything would have gone. So yes, you take risks, but you take a reasonable risk. You take a look at yourself, what you have, and say, how much can I afford to lose? How much? It's like gambling, but not in that negative sense. You're helping build a product, you're helping a company start up, and some have done extremely well. But sometimes you make a mistake on the people because Nigerians can be really, really funny. They come you with fine looking slides and they are talking like, angels. And then they take your money and go and buy a Benz or travel to Dubai for a holiday. And that's 2 months later, they're coming back to you that they've run out of money. So that does happen. And you just, dust yourself up and move on. Emmanuel, investors cherry pick where they invest. Should we, as the owners, look for the right investors? That's a very good question, Emmanuel. Some owners, some founders have also picked the wrong investors. Some investors are just there looking for money, especially when you bring them in as equity partners. because they have a seat on your board or because they have a say, they want to dictate. Oh, why are you giving people Coke during lunch? Why not water? They want to stifle you. So yes, investors need to be careful whose money they accept. That's a very, very good point you made. Some people are just looking for a place to hide their ill-gotten wealth. They don't research the company. They just want to throw money at you. You don't need such people. You need people who can actually mentor you, who can hold your hand, who can give you the benefit of the experience. All right. Any other question? Okay, so I hope you enjoyed this. We'll have just one more session to fulfill all righteousness. I'll be talking about agile, just to complete our understanding of project management. The methods we've been discussing so far, that method is called waterfall, is a traditional project management method. Agile is slightly different, and we'll talk about that next week. And hopefully that will be the last lecture. If you want to have a Zoom meeting after that, today is the 8th, so next week will be 15th. Let me see the week after that. Where's my calendar? No, I can't find my calendar. What's the week after the 15th? 23rd. If there are enough people, I can organize a Zoom meeting where you can actually ask your question face to face instead of having to type. But officially, next week is the last lecture. We'll talk about Agile, and Agile is part of the curriculum. Okay, whatever that date is. So 2 weeks from now, I will set up a Zoom meeting for interaction. No, I'm not going to be teaching anything new, but I'll be taking your questions if you have any. All right, if there are no more questions or comments, I'll say thank you. Enjoy the rest of your day. Prince, you have a lot of questions for today or for any other course? Prince, are your questions for today or for other parts of the course? Okay, no problem. 22nd class. I'll be here by the grace of God. All right, thank you all. I'm going to end the live stream now.